Hey everybody, welcome back. Will Gomez here for Perpetual Pip, and it's time for yet another Trading 101 video. We've made a lot of progress so far understanding the different market aspects, how this market ebbs and flows as the bulls and the bears struggle for control. So we're slowly but surely making our way toward the ability to be able to trade effectively on the market by fully understanding market behavior. We're now on the ground floor. We're going to be talking about the different entry order types that exist. Okay? So throughout the course of this, we're going to explore the different entry order types just to make sure that now that you understand the how, you understand what to do when the appropriate time arrives. So let's go ahead, let's get into this in greater detail. By taking the time to understand effectively how the market works, we're going to be ideally, or I would say better placed, to be able to not only just observe what the market's doing and get super excited and jump blindly into a position, but actually understand the market dynamics and be able to enter in with the greatest effectiveness, allowing us to maximize our profit. So, as I mentioned before, now that we've taken the time to understand the how, we're going to be that much more effective on the when. Okay, so let's go ahead, let's figure out how to identify the opportune time and what to do exactly at that point. First things first, we have to understand the order of operation, right? We've talked about actually, no, I don't think that I've given you that. So I will make sure that I include it here with this. I'm going to include the notes specifically on the different order types, and I'm going to include the 5 steps to trading, the 5 basic steps to trading. So as far as what we've worked on so far, we've talked about how to identify trend direction by using trend lines, right? Taking a nice ocular view of the market, using the trend line to identify the overall direction. Next thing we talked about is how to use a strategy, right? Specifically either identifying whether the market is moving in waves upwards or downwards, or if it's sideways in consolidation, right? The next thing that we're going to get to is entries. That's going to be our next phase. Entries and their orders specifically. Before we can fully get into this, the strategies and how to place or when to place the entries, we need to understand how to go about placing those entries, right? So entries is what we're working on right now. Then we're going to be talking about stop losses and limits. So these are the 5 basic steps to trading. Identify trend direction, determine a strategy. Based on that strategy, find an entry that makes sense or that aligns with the strategy. Then you're going to identify 2 exits, one for a profit, one for a loss, and you're going to, last but not least, consider the equity management. So let's say, for example, that we've been observing an uptrend. The market so far has been making higher highs, higher lows. We probably have heard before, yeah, you want to buy low, you want to sell high, or you want to get in at C and take the ride to the D extension. Right? So we have a working understanding, a loose understanding of how to go about participating. Yeah, I understand the market moves in these waves, and I want to get in to take the ride from the C to the D, get in to take the ride from the C to the D. What I don't know is how. So let's explore that together. This is what an actual entry order looks like. Okay? Now, the first type of order that we're going to discuss is a market order or an instant execution order. So specifically, this means that I am giving my broker, whatever broker you've decided to use, this is a snapshot, by the way, of the trading platform that I use, tradingview.com. However, there are many different platforms out there. Most of the time, the entry order is going to look like this. All right? As long as you understand what these boxes are, then you'll be able to place your order no matter what platform you're working on. But for right now, just know this is from TradingView, the platform that I use every day on my live sessions. So we would tell the broker then, by using one of these orders, we are giving the broker an order, right? We're telling them, look, I see that the market's been doing X, Y, Z. I believe the market's going to continue to go in that direction or turn around, whatever the case may be. I want you to take me in right now. Whatever the market price currently is, I want in, and I want in right now. So we would use a market order to be able to convey that, and we want to participate right at that time. When you fill out a market order, you should also be including exit orders, which means you're telling them, okay, take me in right now, but if the market, you want to also include a stop loss and you want to include a take profit. So when it comes to your market order, since you're entering in at the market price, there's nowhere for you to determine that price. It will be at whatever the current market price is. But you will designate a stop loss and you will designate a take profit. Now, it's not absolutely necessary to identify a take profit or a limit, because if you allow your profit to run, you have a ability to be able to maximize profits, but that's a little bit later on. For right now, for the purposes of basic understanding, we want to have a full trade plotted out, right? So we will put in a stop loss, and this is the designated maximum price that you will allow the market to trend against you. So if I see the markets going up, I know that the market will likely, based on our previous discussions, the market will likely test or retest a previous level of support, right? So I don't want to put my stop loss right at that level. I want to put my stop loss a little bit beyond that, at least 10 pips below or 15 pips above in the case of a downtrend, at least. And the brokers are aware of this, the institutions are aware of this. So you tend to get, if you had the ability to see where everybody is placing their stop losses, what you'll notice is that there's if you take a look at the trading behavior, that this is pretty much standard. So the institutions are aware of this. You'll see a lot of clumping around 10 pips, 15 pips or so below or above a level of resistance and support in any given trend situation. So you may want to consider maybe giving yourself a little bit more buffer, because it's not unknown for the brokers to, I'm sorry, not the brokers, but for institutions in general to target certain price points as a result of that. They're aware that that's how most traders trade, themselves included. So, but we'll discuss more of that in detail later on. In any case, your stop loss is pretty much your cutoff point, where you say, if the market goes to this price, that's it, I'm done. I will not allow this market to go any further against me. This is the maximum amount of risk that I will take. Your limit target, or your take profit, is going to be your designated point where you want to get out at a profit. That's where you hope the market will go, and that's where you're okay with exiting the position. All right, so let's talk about how this works. Let's say that we're looking at, and this is a screen capture from one of my charts, but let's say that we're looking at a chart and we see that the market overall is exhibiting trending behavior. We've been tracking the trend. It's a downtrend. The market's making lower lows, lower highs. So we've arrived at our most recent AB boundary. We see that the market has retraced deep enough to retest the trend line, a deep Fibonacci level, 786, and based on that level, the projected D extension target should be the 1.27. So after the market tests that trend line, immediately after that, we see a bearish decision candlestick formation that takes back more than 50% of the previous bullish candle. So what we have here is a sell signal. If you remember from the candlestick formation discussion, you would note that since the bearish candle isn't greater than the previous bullish candle, it only takes back more than 50%. We have what's known as a dark cloud. If you don't remember the name, that's okay. Not really that important. What is important is that you can recognize the price action or the U-turn that it created at this level of resistance. It came to the trend line, bounced off of it, right? So this is a sell signal. At that point in time, if I spotted that, right, I would go ahead and open up my broker platform or my ticket, my market sell at the current price, and go ahead and trigger that sell position. I would also fill out the stop loss a few pips above, 10 to 15 pips above at least, my nearest level of resistance or above the capital A. We'll talk more about the strategies in future videos. And based on that total distance between the 2 points, I know what the risk is, right? I am looking to enter here at the close of that candle and placing my stop loss above a nearby level of resistance or the capital A. The distance from where I'm entering and where I'm telling the broker this is the absolute maximum that I will allow this market to go against me, that's my total risk. Okay, and based on that risk, I'm going to be looking for a target. My take profit or limit target should be at least 1.5 times that risk. Okay, at least. But again, we'll talk more about that later on. This is just to get traders to be able to see how this would break down on a chart. Okay, you give the market a little bit of room to move against you if it needs to, as it continues to make its way toward a lower low. in the case of a downtrend or toward a higher high in the case of an uptrend. Now, pending orders are a little bit different. Okay, pending orders, just as the name implies, are placed there pending on a given situation. You're placing them in anticipation of a particular event. We're telling the broker, look, I believe that the market is going to do X, so when the market does this, then it's okay for you to take me in whatever direction. Okay? We are designating a specific criteria that must be met before we will go ahead and participate. Now, the problem with these orders is that the nomenclature, most broker platforms are based off of MetaTrader. A MetaTrader is an industry standard user interface to be able to place these orders. If you are using TradeStation, so for example, FXCM is a pretty big broker and they use TradingStation. TradeStation does not require you to specify what kind of order. It kind of figures it out on its own, right? However, most platforms operate off of MetaTrader 4, MetaTrader 5, and this is it requires that you specify. Okay, so you have these two different types of entry orders. Now, why this is a bit difficult is because the nomenclature sucks. Unfortunately, it's not something that I have any say on, right? The way that they named it, they use terms that kind of overlap and can become a little bit difficult to identify. Now, these documents that you see here, I am going to share this with you in the comment section. If you're in the comment section or in the description section of this video, you'll be able to just click on that link or use that link and take it to get the Google Drive document, the notes that I have here on these different entry orders and how they're used. But we're going to talk about that together here as well. So specifically, we have the entry buy and entry sell stop orders. Okay, because the name stop or limit is used, or because the word stop and limit is used in these order types, it can become a little confusing. But please, again, remember what we're talking about here specifically are entry orders, ways to get into a position. All right, we're not talking about a stop loss, nor are we talking about a limit or take profit, which are exit orders to get out of the position. We're talking about how to get into the position. So for the entry buy and entry sell stop, these orders are placed beyond the current market price, right? We're not getting in at market. We're placing them beyond the market price. So if the market touches that price, we're going to be triggered in. The entry buy and sell stop are placed beyond the market price, expecting that the market will move aggressively through our entry price point, allowing us to capture profit at volume. Okay, these are typically used during consolidation. We're expecting a breakout or in anticipation of a fundamental announcement. We are expecting the market to break out of a range, and so we set entries beyond that range to be triggered in. If the market blasts out of that range aggressively to the north or to the south, we're setting entry orders at the borders of this range to be triggered in that direction. We'll talk about that in more detail in a moment. When it comes to the entry buy and sell limit, these orders are placed beyond the current market price as well, but instead of expecting the market to go through our price, we're expecting that the market is going to retrace, touch our entry, and then turn around and go in the opposite direction. Okay? So this is generally used when trading Fibonacci ABCDs. So here's how this works. Here's the entry buy and sell stop order type. If I have a consolidation range, right, then I have an established area, an established ceiling and floor, an average of resistance and support. And what the market has been doing between these 2 points is obviously bouncing back and forth. So what I'm expecting then is either eventually the market will break out in the direction of the trend, or a fundamental announcement is on the way. I can set an order beyond the current market price, either above to be taken into a buy or below to be taken into a sell. If the market were to break out to the north, then it's going to trigger me in at that price, and as the market continues to move bullishly, I'll be making profit. Same thing if the market decides to go bearish. If it falls through my entry price, it's going to take me in and carry me along with it, allowing me to take profit. Okay, so this is when we use the entry buy and entry sell stop type order. When it comes to the entry buy and sell limit orders, things are a little different, right? if we're tracking our Fibonacci retracements, be it an uptrend or a downtrend, our Fibonacci's will look something like this, and we'll have our A-B boundary in place. Now, what should take place next in either one of these situations is the market should retrace toward one of these Fibonacci retracement levels. Based on the Fibonacci retracement level, we're looking to go to the appropriate D extension. Now, you will learn, we've talked about this a little bit in the previous lessons, but for right now, I just want to kind of recap that anything that is the 5-0 or deeper is considered to be a deep C retracement. So a lot of traders will generally not really look to get involved at a 382 or 236. Instead, they're waiting for the market to come down here to these deeper levels. Remember, the closer the market is to the capital A, the smaller your risk is and the longer your run toward the D target is, so allowing for more profit. Most traders will feel a bit more confident if the market is able to reach one of the deep C levels. But not all traders have the time to sit around waiting for the market to touch one of these price points. So instead, what they will do is, in the case of an uptrend, they may decide that they're okay with putting an entry buy at any one of these limits. They'll say, you know what, this AB boundary just formed, the market should retrace, but I don't have time to sit around waiting for this. So I'm going to go ahead and I'm going to set my entry at either one of these levels. If the market touches this level, I'm okay with being triggered into a position. So when the market does in fact, if it does in fact come down and touch one of those levels, they'll be triggered in and they're expecting that the market will turn around and continue along with the trend. Same thing for the bears, right? A trader will choose a level or a price and a stop loss where they're comfortable, and then based on that, they'll go ahead and they'll set their entry at whatever price it is that they're looking for, expecting that the market will get to their price point, trigger them in, and then continue in its direction. Right? So these are the different entry order types that exist. And we want to make sure that we understand this completely before looking to enter into a position. The last thing that you want is to set the wrong type of entry and not get involved when the situation is appropriate or when the market finally starts agreeing with your analysis. Okay? So this is going to bring us to the conclusion of this discussion. I hope that you now have a functioning understanding on the different entry order types. Of course, if you have any questions, feel free to email me directly, will@perpetualpip.com or perpetualpip@gmail.com. I'll be more than happy to get back to you on this. Don't forget about the notes that should be in the description. And of course, if you enjoyed what you're learning, give us a like and a subscribe for more content. All of this content is, of course, available at perpetualpip.com. When you feel ready, join us in the live trading room for putting rubber to the road and for more thorough information, a live environment where you can ask questions at your leisure. This has been Will Gomez for Perpetual Pip. Thanks again for joining me. I'll see you next time. We're going to be talking about how to trade candlestick formations.